Welcome back to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. For the second half of our show, we're pleased to have Richard Swart, partner and director of research from Crowdfund Capital Advisors, to discuss the Jumpstart Our Businesses Act. Richard, welcome to the show.
Thank you, Bill. Pleasure to be here.
Richard, before we get into the details of how the new Jobs Act might open up crowdfunding opportunities for startups and individual investors alike, take us back. Take us back to the days when unbridled free enterprise allowed any American to invest in any business he pleased, and the great entrepreneurs and investors of the late Industrial Revolution were changing the world.
The history of innovation in America is primarily based on allowing people to make decisions about where they want to allocate their risk and put their money. And there was basically nothing that the government did or said, and there were no laws on the books that affected your ability to make investments up until the great crash of the 1930s. Many fortunes are made from investing in early stage companies. There's research out there that shows that the vast majority of fortunes can be traced to investments in private stocks, private companies before they hit the public stock markets, because it's that ability to get in early to something that then grows and becomes significant that creates fortunes. It doesn't create 5% returns, it creates wealth.
Well, so many of the famous names we know today, Ford, Kodak, which of course has come and gone through its whole cycle, a lot of these companies were started basically with crowdfunding. They
were social capital raises, not crowdfunding as people think about Kickstarter or Indiegogo, but people reached out to their communities, people reached out to their circles of influence, whether that was their church or their synagogue or the Masonic Lodge or whatever their networks were in their towns, and they cooperatively raised money. I mean, social cooperation is part of the world's history. I mean, there's still thousands of cooperative investment clubs and financing groups in Asia. That's the most common way that innovation occurs around the world, whether you're in the Middle East or Asia or South America. People join they convince people to back someone's vision, and they pool their resources and pool their funds, and they launch a company together.
And most of this is done without professional intermediaries.
Oh, absolutely. There's zero intermediation in most of these models.
So what problem was the government trying to solve by making it illegal for ordinary people to invest in startups, reserving that right for only the wealthy?
I believe that they thought they were protecting the average consumer from losing all of their wealth. And the majority of stock and securities regulations are all a reaction to the 1930s, the great stock market crash. The laws were invented in the era of telephones and teletype machines. So you had
limited information
and a one-way channel of communication. So someone literally picks up a phone, calls a potential customer, and tries to sell them a security. There's no Google, there's no web searching, there's no ability of a potential investor to search for information on their own or to make decisions. They basically had to rely upon the representations of the person on the other end of the phone. So the government came in and said, well, we need to standardize things. We need to have disclosures. We need to have pre-registration. We need to have certain accounting checks done. And I believe they thought that by protecting the average consumer from losing everything, and that was basically designed to prevent the next crash, because most securities regulations are all about effective disclosure and investor education. But they have not updated any of the rules or regulations to reflect the modern availability of information. The framework of their laws were written for 70 years ago.
It's like truth and labeling laws. You can sort of understand the impetus behind disclosure, but why did they exempt rich people, which I guess what we call accredited investors? Maybe you could describe what that is.
I would argue they're not the very rich, as most people would think about it. It's someone who has $1 million of net worth, not including their house, which was a recent change to the rules as a reaction to the recession 2008. Or they have an individual income of $200,000 or a combined family income, I believe, of $275,000. So it's definitely the upper middle class. It's probably the upper 10% of earners, some business owners, not all, many attorneys, entrepreneurs, medical doctors, people like that. So it's definitely the upper 10, 15% of the income strata, but it's not the very wealthy.
Okay.
So we need to be clear about that.
So they're allowed to invest as they please.
They can do whatever they want with their money. They have access to opportunities for investing, not just through crowdfunding, but there are so many investment opportunities that are restricted only to accredited investors. And many, many times the average person cannot even learn about or discover these investment opportunities, let alone be allowed to invest in them.
And what's the theory behind that? Is it because they're supposed to be smarter, or because they can afford to lose more money, or why are they different?
The rhetoric is that they can absorb the loss. They have enough money that they can take more risks. And so someone making, $500,000 a year loses $100,000 on an investment, they're not going to rely upon the social welfare system. If, however, somebody making $80,000 a year loses all their life savings, the government then believes they're going to have to take care of that individual. So I believe, and again, I'm not speaking for the government, but I believe the logic is based on protecting the lower wage earners from loss.
So if I make $50,000 a year and I take $50,000 and buy lottery tickets, is that a legal thing to do?
Absolutely. You can go to Vegas and blow it tomorrow.
So
you just can't put that money in private stocks.
Right.
You can put that money into public stocks,
okay,
but not private stocks.
Well, let's talk a little bit about the difference between public stocks and private stocks. Maybe there's an angle there that will help explain this regulatory behavior. Is it because public stocks are so much more liquid?
It's a combination of liquidity, and also there's a whole series of filings and disclosures that it's extremely expensive and time-consuming to list a company on a public exchange.
Okay, so it's got to be more mature than a
more
startup.
mature. Frankly, it costs a lot of money to take a company public. You have to be a later stage company with revenues, and basically you have to be at $100 million in revenues to list on the New York Stock Exchange now. So those are large companies. The vast majority of companies are never going to make that number. It's used to have a pretty active and robust system of pink sheets and over-the-counter stocks and smaller stocks. Most investors stay away from that. And unfortunately, many of those trading floors have very bad reputations because of some scams in the 70s and the 80s that occurred. So there's sort of a perception that anything that's not on a public large stock market has to be full of a lot of risk.
Which is probably not inaccurate. I mean, it's a very risky world out there in the startup community. And you better go in with your eyes open because most startups fail.
Yeah, the vast majority, 70, 75%, depending upon the literature, are not going to succeed. And sometimes they I use the joke, someone should pull the plug, they're on life support. They continue to trickle along, and maybe they haven't quite failed yet.
But they're really
zombies. They're never going to go anywhere. And many times that's a function of the entrepreneurs don't know what they're doing. They don't have any experience. They haven't had market validations. 100,000 things we could talk about why companies fail. But the data is, absolutely undebatable that most early stage companies will not succeed.
So the regulators, looking out for our own good, want to make sure that we don't lose our money unless we're, fairly wealthy and sophisticated. Kind of like the FDA wants to make sure we don't take drugs that are unsafe. The cost on the FDA side is the cancer cure that never comes to market. What's the cost on the entrepreneurship side by stopping most Americans from investing in startups?
Well, there's been a over 20-year decline in the rate of entrepreneurship in America. We are deluded if we think that America is an extremely entrepreneurial country. We actually rank, I think, somewhere in the mid-30s.
It's going down.
It's going down precipitously. It's dropping like a rock. And it's a function of several things. Part of it is banks aren't lending to small businesses, and I don't care what they say. If you look at the data for the past 28 years in a row, the amount of money lent to small businesses as a function of the bank's portfolio has declined year over year over year over year. So if your banks aren't lending and you can't approach venture capitalists unless you're a very narrow segment of companies that can scale dramatically and attract the interest of a venture capitalist, you don't really have a lot of options for financing. So the financial markets really do not provide much benefit for early stage and small companies in the U.S. any longer.
So the cost of not letting Americans invest are the companies we never see.
It's the companies we never see, and the job skills are never acquired. I always use the example of what does a kid in Peoria do who has a associate's degree from a decent community college, but this kid's going to stay home, help the family, maybe help with the farm. This person's never going to go to D.C. or San Francisco. How does that person acquire job skills? They're not going to get hired by Procter & Gamble to go work in a new product innovation lab, but oftentimes smaller early stage companies take students like that, take young people, throw them into an environment, and they just have to learn a whole series of skills.
It is an incredible learning experience to be at a startup.
Yeah, and even just earlier stage companies, maybe not even a startup, but maybe a company in year 3 or year 5 that still only has 10 employees or 8 employees. You don't have the organizational corporate structures of working for a major corporation. You get done what has to get done, and you learn a lot of things. So part of what's missed is the human capital, the ability of getting people job skills and job experience and exposure that they're just not getting. I mean, the youth unemployment rate is phenomenal in the United States right now. Kids are graduating college and they literally can't find a job.
So, Richard, a law called the Jobs Act, Jumpstart Our Businesses, was I believe, passed in 2012. It's still being finalized in certain areas, and it's supposed to address some of the issues you talked about earlier. Tell us about the history of that legislation.
It's actually a wonderful story. Three gentlemen, Jason Best, Sherwood Neeson, Zach Dorian, are entrepreneurs. They each have successfully scaled companies. And if any of your listeners have kids and you go to Walmart or Walgreens and get cough syrup or medicine, and they ask you, would you like that to be flavored with, cherry or bubblegum? That was Woody's company. It's called FlavorX. So these are successful entrepreneurs. Between the three of them, they had raised, I think, $81 million in venture finance. They had had 4 exits. So what that means to a venture capitalist is that these guys can run companies. These guys can be successful. So they were trying to do another company in 2010, couldn't get anywhere. 2011 couldn't get anywhere. They started doing some research, saw that Australia was doing crowdfunding, and they thought, hey, this is perfect. We can marry social media. We can marry all these new tools and technologies. Why can't companies use these new tools to reach out and finance themselves?
And by crowdfunding, you mean a large number of small investors rather than a small number of large investors.
Right. So have 1,000 people give you $500 instead of 50 people write $10,000 checks. And they went to the SEC, being entrepreneurs, not attorneys, and they asked a very naive question, which basically is, why can't we do this? And they were told that would take an act of Congress. So they went and got Congress to pass an act.
Good for them.
So it's a bunch of entrepreneurs that are not attorneys. They're MBAs. In fact, they're all Thunderbird graduates from Arizona, really smart guys. They're friends of mine. They literally lobbied Congress. They drafted what's called the startup exemption, and that website still exists. You can just go to www.startupexemption.com. They sat down around a kitchen table, drafted out, here's what it should look like. And they didn't know better. So they went to D.C. not being lobbyists, not being attorneys, and they got enough attention, and they were able to actually get Congress to consider their ideas. And lo and behold, the Jobs Act passed about a year later.
So far, the only thing we've seen in that, though, are people raising donations, not so much people selling equity shares.
No, the Jobs Act has nothing to do with donations. The Jobs Act all has to do with securities. So Kickstarter, Indiegogo, and hundreds of other donation-based and rewards-based crowdfunding sites were around before the Jobs Act.
Okay.
What we're talking about is being able to sell securities, being able to sell a debt or a piece of stock to investors through crowdfunding platforms. So the idea is allowing a small company to use a crowdfunding platform instead of going to an angel investor or a venture capitalist or getting a bank loan.
And what is the state of that legislation? I understand there's still some unfinished business.
There's one piece called Title II, and I won't bore your listeners with the legalities. Basically, Title II is the accredited investors, the wealthy people. That piece went through about a year and a half ago, and that part of the market is already very up and running, and a lot of people are using it. And it's allowing accredited investors to invest in these companies. And that is scaling very nicely. It's still going to be a small slice of the market. I mean, it's not taking the place of venture capital, but it is effective. Now, the part that the SEC is stuck on is allowing non-accredited investors to put money in. So the average citizen or retail investor, they have not passed the rules. And it's been over 1,000 days now since the law has been passed. They put out proposed rules well over a year ago. And the original legislation was 8 pages. Their proposed rules was 595. Excuse me, it was 285 pages with 595 questions.
What are they afraid of?
They don't know how to assure that investors are adequately educated. So they want to know how you make sure the average person understands what it means to invest in an early stage company.
There's no way they'll understand. I mean, VCs have a hard enough time understanding it. I mean, the public's going to be taking shots in the dark. What's wrong with that?
They think that they have the responsibility to, quote unquote, create a framework for adequate investor protection. And I don't think you could make an argument for not educating people. You could lose all your money. This is a high-risk investment. Early stage companies oftentimes fail. Do not put your life savings in this.
Right.
And the law actually caps the amount of money you can put in based on your income. If you make less than $100,000 a year, you're capped at $5,000 a year already.
Isn't that enough?
That's part of my argument is if we already limit the investments, aren't we protecting investors already? But there's been a massive pushback from Barbara Roper and the Consumer Protection Lobby, and they have very effectively and vociferously been lobbying Congress and the SEC that this is going to be a disaster, and they're making the argument that this is going to be fraught with fraud, as opposed to just it's an early stage new form of capital and there is a significant amount of risk. So when I talk about it, I say, this is your speculative investing. Take 2% or 1% or 5% of your portfolio that you can play with and you can afford a loss and put it into these companies.
Well, your fraud is in the eyes of the beholder. I mean, it's one thing to raise a bunch of money and then take off for Venezuela. It's another thing to promise that you're going to build an anti-gravity machine and find out that the laws of physics are against you. The latter thing happens all the time in the VC business.
Oh, yeah. We've seen multiple examples. One person had a crowdfunding campaign on Indiegogo where the video was actually a clip from a Star Trek movie, and it was basically a 3D hologram, and he was claiming he had invented a 3D holographic technology.
That was bona fide fraud.
Bona fide fraud / insanity, one or the other. But the crowd very quickly detects and sniffs that out. That's one thing that's interesting about crowdfunding, since you have the ability of people to look at it, and this spreads through social media. Typically within about 24 to 48 hours, people go, hey, something's not right here, and they call people out.
So you get community due diligence.
Broad due diligence. And the laws are not designed to trust the community to do due diligence for each other. There's no structure in those securities regulations to allow that to happen. Now, the other question is just the fundamental nature of early stage investing. You know, people don't understand, you know, I've got, IRAs and 401ks like most Americans. I know that it's being managed by somebody. I know it's a huge fund. I know that I'm going to get a very small return. But that's what, that's what pensions and corporations do is you set up 401k plans.
And by the way, it's entirely legal for that IRA and 401k to be invested in toxic bonds and the most obscure and strange derivatives. That's not against the law.
No. And the assumption there is that you have a quote-unquote professional fund manager looking out for the interests. There's nothing about the risks those people choose to take, but the assumption is that there is a quote-unquote professional. And the reason I'm saying quote-unquote is that many of them have horrible returns. And only a small number actually have a long-term track record of good returns.
Sure.
But it is true that early-stage investing, and I've both run a startup, I've had an exit, I've also worked for a venture capital firm in the past. It's a lot of art and not a lot of science, trying to figure out which team is actually going to be able to execute. Which combination of market forces and timing and sheer luck is going to allow this startup team with a similar idea to succeed versus this startup team? So the implication of that is, if we're talking about a true startup, the only security that I would say is good as a diversified portfolio. So invest in 20 or 30 or 50 of these and put $100 behind 50 and see what happens, as opposed to putting 10,000 behind one.
Now, if you're going to be putting that small amount of money, you can't be spending half of that on legal fees. These have to be pretty simple equities.
Yeah, it would be a very simple instrument. Otherwise, it makes no sense. And the costs are extremely high, by the way. The amount of accounting and review that the SEC requires the companies go through makes these incredibly expensive ways for companies to raise money.
So it sounds like the Title III piece of the Jobs Act that would allow any Tom, Dick, and Harry to invest might end up being stillborn.
The general perception is that Title III is dead on arrival under its current structure. And we have to understand, I won't go through all the sausage making, but the really short version is Congress passed a version which would be pretty libertarian. So it's sort of a trust the consumer, caveat emptor, not a lot of regulations. That got kicked over to the Senate. Harry Reid got a hold of it. Very quickly, they decided they wanted to pass a bill. It was the election cycle right before the 2012 elections. They wanted something with the word jobs in it. They smashed together a compromise piece of legislation and got it out the door. And by the way, the Jobs Act has had the highest bipartisan support of any piece of legislation in the last 6 years.
Interesting.
410 to 17 in the House. So it was sold as a way of helping create jobs through getting capital in the hands of small businesses. Then it was handed off to the SEC, and the Consumer Protection Lobby went crazy. And it hasn't changed since then.
But you said the accredited investors are already beginning to play. How's that working out?
The laws allowing accredited investors to invest went live in September of 2013. Since then, there's been something like $12 billion of filings where people are trying to raise money through these registration requirements. The sea change that most people aren't aware of is that if you file under Title II, you can use what's called general solicitation, which is a fancy way of saying you can advertise the fact you're raising money. That has been illegal in America for the last 80 years. Mm-hmm. So this is actually a significant change, that companies are allowed to advertise the fact they're raising money. The SEC says, okay, if you go out and you share through Twitter and social media and billboards and whatever you're going to choose to do, you have to spend a lot of energy and time verifying that the people that are coming to you are actually able to invest in your company. Mm-hmm. So the burden is shifted to the companies to verify the information about the investors, and they ask for so much information that a lot of those investors choose not to go through with the deal because they feel like it's too much disclosure, too much information. And part of the irony is every single investment, you have to go through that due diligence. So you invest in the first company with $5,000 and you go through 10 hours of providing data. Mm-hmm. You get to do that again the second time. There's no credential that carries with you from investment to investment.
Isn't that strange? In the VC business, people self-affirm that they're accredited investors.
They're not allowed to. If you advertise and you do general solicitation, you cannot accept self-affirmations anymore. So Title II is working relatively well. One thing that's interesting, though, is that the vast majority of people that are trying to raise money through this Title II are not startups, they're real estate developers. They're people looking for real estate investing. Yeah, exactly.
That doesn't smell good.
So far, nothing's happened bad, but the problem is, average consumer, how do you know what the price per square foot for a commercial property being redeveloped in Detroit should be?
Right.
You don't. And so I think some people have a false perception that real estate is inherently safe, or that your losses are going to be extensively mitigated. And so, I don't want to exaggerate, but there's a massive interest in the real estate industry, and can they use these new mechanisms to bring in investors to their deals? So it's turned into less about startups and more about a new way of syndicating investors.
Richard, with all the potential problems with crowdfunding, where is it working?
The irony is crowdfunding works really well in most of the world. There's crowdfunding going on in Asia, Europe, the United Kingdom, South America. The European markets and the British markets are robust, functioning well, and they have been for many years. So we know this model can work, which is part of the irony of how do we justify all the regulatory backlash that we're seeing, given that the evidence shows that it works. But let's talk about the process of raising money for a second. The key is that crowdfunding is not just about funding. It's about connecting entrepreneurs and business owners to a community of people that care about what they're doing, learning from the feedback they get through the crowdfunding campaign, improving their products, improving their services. Oftentimes they recruit key employees, they find distributors, they find partners.
Trying to build a virtuous cycle here.
Right, it's a virtuous cycle, and there's a lot of data. If you talk to people that have been successful in crowdfunding, they say the money is nice, but if you make me rank order the outcomes, learning about my market, learning about customers, finding key partners, finding distributors, finding interns, the money is like the fifth or the sixth most important thing. So what crowdfunding allows companies to do is to compress a lot of the early stage discovery and learning about their market and their community and their products and what's going to be sold, and the financing process into a very short window. So it allows you to fail quickly, understand your product, understand your services, and it also connects you through social media and face-to-face interaction with hundreds of people. And those people can then mentor and support you. So even something like 60 to 70% of people that fail the first time in crowdfunding say they would do it again.
Richard, what should we expect in the years ahead?
We're going to see this take off. This is inevitable. It's the marriage of social media, new ways of communicating, and new models of financing. So eventually this is going to work, and we just have to sort of figure out how to get around or work with the government to make it effective, because we've seen it work in other countries. What we're going to see is radical changes in the way that new businesses are formed, the way they take products to market, and the way that they learn about what customers demand, and that's going to occur through crowdfunding and social interaction. So companies don't exist in bubbles any longer. Companies exist in networks and relationships. We're going to see Congress fix this. There's already proposed legislation before some of the committees in the House. Now that the Republicans are in control of the Senate, they believe that they can pass some legislation. We're going to see many of the problems in Title III fixed in this legislative session. Hopefully we'll see in 2016 a framework that allows the Jobs Act to take off and flourish.
Richard, we'll certainly be keeping a close eye on this. Thanks for being on the show.
It's been a pleasure. Thank you, Bill.
That was Richard Swart, partner and director of research at Crowdfund Capital Advisors, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. Real Clear Radio Hour is produced in conjunction with Real Clear Politics, America's premier independent political website. If you'd like to hear more, stop by realclearradio.org to sign up for updates on our weekly broadcasts or access podcasts of our past programs. That wraps up our show for this week. Join us next week, same time, same station. See you then.